After those back-to-back record closes to start the week, the TSX down several hundred points, as you saw. Our next guest says the bull market is still alive for 2026. Let's go to Brian Belski, CEO and CIO of Humilis Investment Strategies. Thanks for joining us today.
Thank you so much for having us, and good afternoon, Canada.
You expect positive returns this year, but more muted in nature. What are you seeing that paints that picture?
We do for both markets. Canada had an amazing year last year, as you know, from an absolute performance basis. When you look at local currency, it's best absolute performance since 1990. That was really driven by two out of the big three sectors had a wonderful year, especially materials driven by gold. But I do think that relative outperformance is probably going to wane in 2026, especially given the more diversified nature of the U.S. market, number one, and number two, is kind of some of the gas is going to come out of the momentum. Here's why. Canada, for all intents and purposes, is a much more cyclical market than the United States. The United States is more of a secular growth market. When you take a look at how the markets in general in North America, both Canada and the United States, have been driven for the last 4 years in particular, it's been about multiple expansion. When we go back and look at our historical studies, long-term strategies, we've been doing this for 36 years or so, we found in our backtesting and our analysis that principally multiple expansion-driven markets, which have been the markets the last couple of years, are the most powerful. In earnings-driven markets, although still positive, are not as powerful. We believe that both Canada and the United States are entering an earnings-driven market. Doesn't mean it's bad. It just means it's not going to be as good. And you can just kind of take 2 steps back and think about it as positive is still positive. And we still think investors should not time the market, remain invested, and own the best kind of high-quality companies in Canada that Canada has to provide.
Okay, you also say it's going to be a bumpier ride this year than last. Last year was pretty bumpy. What are you attributing the bumpiness to?
Well, let's take 2 steps back. It was bumpy for about 2 weeks, right? And then the market rallied back pretty strongly, which showed the resiliency, especially of the U.S. market. Part of that bumpiness was driven more by fear than fundamentals. We had exogenous events at the beginning of the year with respect to what was happening in the United States in terms of policy. But bumpiness, quite frankly, is, again, when you transition more from a momentum market and a valuation-driven market versus earnings. Now, again, if you take a look at how Canada is as an index and with its companies, it gets much more cyclical. So we think the earnings growth in Canada is going to be more cyclical and a little bit less discernible than the United States, which could cause some of the bumpiness. But again, that doesn't mean that you should be selling. I think most investors typically, in my experience, sell at the wrong time. So you're going to have some weakness, then they'll sell. We certainly saw that last year when a lot of private wealth investors that we speak with all sold the U.S. in April and have not come back. So that they've missed a heck of a run with respect to what happened in the U.S. between April and the end of the year.
All right. So how would you caution investors, if caution is the right word?
I don't think caution is the right word. I think you have to be disciplined. And again, if you take a look at some of those areas that have been super, super strong, like gold, why don't you take a victory lap and take a little bit off the table? It's okay. Or some of the banks have been very powerful in Canada. Most of that power, quite frankly, of the big five and the sixth one in Canada has really been driven by those banks over-reserving. So they had excess cash, and with those excess cash, they created earnings and paid off bigger dividends. Over the short term, that doesn't really last. Over the long term, it does, but over the short term, it really doesn't last. So we think some of the gas could come out of banks in particular. And so we've been more neutral heading into 2026 for banks. So I think you have to be a little bit more process-driven, a little bit more disciplined, but remain invested longer term and increase your stock picking instead of just buying a broader index, meaning you want to be buying up individual companies, we think, in 2026 versus just buying an ETF-driven TSX product.
Okay, I was going to ask you what your themes are for this year, because, of course, AI was a big theme last year. People were buying up sort of everything they could. But you're saying not certain sectors to look at, but certain stocks.
Yeah, we really believe that the AI theme is real. We're going to see increased dispersion. It's not going to be just because every stock has something to do with AI doesn't mean it's going to go up. I think we're going to see very specific themes in AI, especially around the utility space. We think a lot of the old school utility companies that are going to benefit from a lot of these AI companies and data centers needing more power. You think about it. How do companies generate power? They plug themselves into the wall. Who owns the plugins? Well, Fortis and Canadian Utilities. So, I mean, those types of names I think are underexposed in a lot of people's portfolios and not really understood. I think from a contrarian perspective in Canada, the communication services area has been way oversold and way under-owned. And we also think consumer discretionary. If you think about the resiliency of the Canadian consumer, everybody talks about how strong the U.S. consumer is. Man, the Canadian consumer is excessively strong, and that's why we continue to love names like Aritzia and Dollarama are our two favorites.
Okay, those are good ones to watch. We thank you for joining us today. Brian Belski, appreciate your time, sir.